Bharat Iyer of JPMorgan, he remains constructive on Indian markets at current levels, but believes that the market will consolidate some more time around these levels. He also recommends investors to play themes like financials and infrastructure stocks. Hear the detailed conversation.
What's your take? Because the street still seems a little divided on whether or not metal stocks can be pushed at least 8 to 10% higher from here, or is it time to completely take your money off the table?
Aisha, it's very relevant that you ask me this question, because just last week we downgraded the metal sector from an overweight to neutral. Basically, the sector's had a great run over the last 18 to 24 months. And we see near-term headwinds building up for a couple of reasons. One is, the global reflation trade that was expected, I guess, has been put forward, both in terms of, the timing and the pace of recovery. So, that's one headwind that's building up, and it's reflected in commodity prices correcting. The second issue was, while commodity prices and commodity stocks were correcting through February and March, the Indian stocks held out. And that, I think, was because of India-specific reasons. So, there was a catch-up trade also where, the Indian stocks had to, catch up with their global counterparts. So, we thought, we'd had a very good trade there, and we decided to take some money. So, the view is that, over the medium term, I guess the Indian stocks will make money for you because there is significant restructuring potential. A lot of them have a very solid volume growth story coming forward, particularly because, a lot of them had issues in terms of utilization levels for regulatory reasons. So, I think there's a very compelling restructuring and volume argument coming, but we'll wait for both this period of seasonal weakness as well as more clarity on the reflation trade to come in before going overweight again. Is
that the case with the rest of the market as well?
Yes.
Outperformance, seasonal weakness, just maybe get a little cautious?
Yes. I mean, that was one of the themes of our monthly strategy that we put out last week. We believe the markets have had a great run beginning December all the way through March. And while medium term we remain constructive, we think it's time for a breather.
And why is that? I mean, because globally as well, things are not supportive. Is it just a valuation thing? Can we not do better than 90 to 100?
I think it's a combination of reasons, Aisha. When we turned positive in December, it was really on the back of three factors. One is we thought that the demonetization scare was overdone. Two, we thought that January to March will be a very supportive period for the market in terms of policy. And third, we are buyers of the argument that there'll be a meaningful earnings recovery into 2018, FY18 that is. And we set then a target of 9,300 for the Nifty base case and a bull case target of 9,600. The issue for us is that the first two triggers have played out, and the Nifty is at 9,200. So, all we're saying is that, look, I mean, and the third trigger we are talking about, which is the earnings recovery. I guess, the recovery is going to be there, but it's going to be patchy. And it's going to be back-ended, perhaps into the second half of fiscal 18. Because through the first half, you still have to get through a few headwinds. So all we are saying is that, look, I mean, you had a great trade. I mean, the market's going to pause for a breather and then pick up perhaps sometime into the second half.
So are we stepping into time-wise correction or price-wise correction?
I would say time-wise correction more. I don't see a meaningful price correction, i.e. something which is beyond, say, plus or minus 5% for local reasons alone. Because, I think there's a great deal of macro stability, there's a great deal of political stability. So I don't see the market selling off for local reasons alone. But yes, I mean, if there's an international issue, then I mean, we'll perhaps, go along with that, because at the end of the day, we are a consensus overweight market. But for local reasons alone, I think, it's more a time-wise correction rather than a price correction.
Do you suspect globally things could get a little more higher than what is already in the price right now? Because again, if you talk about the US market, that's somewhat like India, or maybe we are following them post-election, craziness in the markets. And now with these geopolitical talks, you've got the UK impending election as well. Things seem to be getting a little bit wobbly.
I would agree with that. I think, you're right in the sense that, again, globally, if you see the medium term, I mean, we as a house remain constructive on equities. And, in our global multi-asset portfolios, we are running an overweight position on equities with a particular focus on emerging markets. But that said, you could have 3 or 4 choppy months. You have a packed political calendar, the French election, the German election, now the British election, how policy pans out in the US given the high level of expectations. So, and which may not necessarily be met over the near term. So you are right. I mean, politically, I mean, the next 3-4 months could be choppy for markets.
So it'll only be choppy. There's no steep correction that we could see globally.
Not that I can see. See, I'm not an expert on the global markets, yeah. But so I defer to my global colleagues on that. But I think there is a case to be made for a time-wise correction and some choppiness.
Okay, great. So what would correct? We've already talked about metals. What else is looking like an eyesore? Because if one looks at the private banking numbers of late, they have those sticky 1 or 2 accounts because of which their NPAs are still getting hit. And you know, you always prefer the private banking lot. So one is a little taken aback by what one's heard from Yes Bank or in
You're right, Ayesha, in the sense that, you know, if the broad market is going to, you know, time correct or, you know, be a little choppy, then I guess, you know, financials will have to lead the charge because, I mean, they are such a large part of the index and they've also been meaningful outperformers. So while the medium-term story remains constructive for the private banks, I think near-term, yes, I wouldn't be surprised to see a correction. Not a very big correction, but 5-7% I wouldn't rule out.
No, but I'm talking about the trigger here, the fact that NPAs continue to be a concern. There's always that one sticky account. I mean, yesterday it was JP Associates, tomorrow it's going to be someone else.
Point taken, Ayesha, because again, if you see, you know, there's been a fair bit of bad news building up on the financials front in the last 2 or 3 months. You know, you had the RBI signaling the end of the easing cycle. You had, you know, the farm loan waivers. You know, you have credit growth at just about 5%. You have festering credit cycle issues.
Still no NPA policy.
Exactly. And, you know, I think the markets stayed supported. You're absolutely right. You know, the financial SPAC has been entirely it's state supported because, you know, people are expecting this big NPA policy. And, you know, it's ignored all the bad news. So a lot is going to depend in the next month or two. If you were to take a very near-term view, it's going to depend on 2 things. One is, you know, you need this NPA policy coming out and it has to meet market expectations. And, you know, you need the NPL numbers to behave themselves. Because if these 2 things don't happen, you know, the sector has to make up for some bad news.
Yeah, and the scope for disappointment therefore
The scope for disappointment is immense because you've ignored all the bad news.
Absolutely. What's going on with the broader markets? Does it, you know, one keeps thinking that every morning when you have the Dow correcting by about almost 1%, it's the broader markets which are going to fall. But some of these mid caps, the likes of the D-Marts or, you know, Sun TV or India Cements of the world, they're refusing to fade away. Do you sense that there's a bigger bubble waiting in the near term when it comes to broader markets?
See, broadly, if you ask me, I'd agree with you that perhaps, you know, the mid caps are trading at a meaningful premium to the large caps. So in the event of a correction, then, you know, the mid caps are more vulnerable to the large caps. But that said, you know, it's very difficult to paint them all with the same brush because, you know, mid caps tend to be very unique stories. And, you know, in some cases, the valuations are very beaten down or very compelling. In some cases, there's a scarcity value. So, you know, you'll have to take a very specific approach to these. But yeah, broadly, I agree with you that, you know, mid caps are trading at a meaningful premium to large caps. And in the event of a correction, they are more vulnerable.
So what are your biggest overweight, underweight positions right now, sectorally?
See, if I take a 1-year view, we like 3 themes in particular. One is, on a 1-year view, we still like the financials. We think, you know, there's a lot of liquidity sloshing around in the system.
What within financials?
I would say, I mean, the private sector banks, definitely the retail banks. I mean, again, within private sector now we have to, you know, start segregating. The retail banks, I think, still have a great compounding story, I think, which will continue to unfold. On the corporate lenders or, you know, the larger lenders, I think, you know, a couple of banks look interesting because, you know, they seem to be ahead of the curve in terms of, you know, sorting out their credit cycle issues. And I think they have been, you know, the markets are going to appreciate them for being more honest in terms of their disclosures. So I wouldn't rule that pack out completely. The other area within financials which looks very interesting is the mortgage companies, the housing finance companies. Because, you know, what's happened with demonetization is, on the one hand, real estate prices have corrected. On the other hand, rates have fallen. So affordability levels are, you know, at 6-7-year highs. And so if you take off pockets in Mumbai and NCR, I think, you know, markets look like they're reviving. So this is what we'd buy in financials. The second theme that we like is, you know, select infrastructure plays, because I think the government is doing a very good job of, you know, investing in a few areas which are priority for them. Areas like, you know, highways, power transmission, rural housing and sanitation, irrigation. So I think, you know, segments catering to these like, you know, cement, construction equipment, tractors, you know, the power transmission companies, all of them look very good to us. And, you know, for us, they're 2-3 year plays. Utilization levels are still 70-75%. So there's a lot of leverage on the way up. So we believe that, you know, these are core holdings for us, at least over the next 2 years or so. The third theme that looks interesting is urban consumption, because, you know, you had the government push through the pay commission recommendations. I think the state governments and the state-owned companies will follow suit. You had a meaningful, you know, 200 basis point cut in lending rates over the last 2 years. 100 basis points happened in January itself, courtesy demonetization. So I think urban consumption looks good. So these are the 3 themes which we really want to play over the next 2 years.
Okay. You know, you talked about your rationale behind liking HFCs. Is that the reason why you're seeing this excitement within the real estate pack? And do you think the best of it is already in the price?
See, as far as real estate is concerned, I think, the reason the stock prices have gone up, I mean, has got only partially to do with the fact that you may see a pickup in, sales. I guess it's also got to do with, very specific restructuring initiatives that some companies have announced in terms of, spinning off the commercial portfolio and ensuring that, value is attributable to that. So I guess, those are more unique stories. I don't think, there's an across the board, positive sentiment for all the companies.
How is it that you're seeing the entire government PSU space right now? I mean, after OMCs, do you see more areas to be taken up by the government, maybe fertilizers?
See, I mean, these are clearly very big opportunities because they are huge enterprises and they are clearly monopolistic and they are catering to essential needs of the farmers or some segment of the society. So, business possibilities are very high. The profitability got impacted because bulk of their products are subsidized and government obviously didn't want to give extra money more than what is the cost of production. So, how will these enterprises flourish for the shareholders? Second, since it is subsidy, the compensation to the most of the manufacturers were based on cost plus or some kind of a committee, or it is very difficult to see the future of these companies. And stock market is only about seeing the future. So, you can never give high P multiple where future of these companies are not certain, even if they are making profits. But if the future profits are always under threat, then the investor will never give you high P multiple, and hence you can make very limited amount of money despite high profits of the PSUs. So, these issues, apart from deregulating, they must deregulate with the very firm conviction that this is what will be followed irrespective of whatever happens. As the market gets confidence on the new sets of laws or new rules of the game, market will start re-rating all the companies.
Okay, so how is it that you're assessing the reform process so far by the government? Do you think they're playing on expected lines and delivering as per the commentary?
Yeah, I mean, see, beyond out the headlines have changed, the quality of commitment, the talk by the ministers, what decisions have been taken, the pace of decision making, understanding of the problems. I mean, everything is right, and they are taking decisions which are at times which is unpopular, but good for the nation, good for the people.
So Raamdeo, how would you map the FY18 in earning scenario? The general consensus is that earnings recovery is around the corner.
No, so far the results which have come, and so I am not that hopeful on the very broad based earnings recovery or anything like that. But select companies will do very well, and that is going to remain the trend of the market for even the next 4 quarters, that the earnings will be very sector focused or few company focused rather than very broad based. So, and we are hoping that we can catch enough that 15-20 companies in portfolio which will have good prospects and good earnings growth potential while we are holding them.
So Raamdeo, in this market where it's difficult to find value, how are you putting your money to work? Incrementally, where are you investing?
Yeah, so flows have been very strong. I mean, actually the flows started happening from January 2014. So 3 years have been relentless this thing, but we are seeing for last 2-3 months the flows to become even stronger. Like March was very large month, April is also shaping up to be a record month. So the flows till yesterday has been fantastic. Now with the flows, the markets are also very high. So our conventional companies where, I mean, the entire portfolio where it was, I wish our NAV is high, but my portfolio valuation remain more attractive at the current level. But I think the challenge is to find new quality stocks at reasonable price. Quality stocks are there, but finding them at reasonable price and putting them in the portfolio in a substantial quantity, that remains a challenge. But I still think we have enough ideas where we can deploy current flow of the investors' money.
That always is the big challenge, isn't it, Raamdeo? But what is it that you're making of the risk-reward currently for the overall market? Because it seems like of late that's getting a little bit challenged. There's been some escalation of global fear with regards to geopolitical tensions and political, uncertainty as well within the UK region. And then for our market, the fact that we're already at all-time highs. How are you mapping the risk-reward ratio right now?
No, I mean, when the market goes up from say 8,000 to 9,000, your prospective return for 1 year or maybe even 2 years get impacted significantly. But the guys who are coming for 3 to 5 years, 7 years, I think the impact is very minimal, and it is not worthwhile, timing too precisely whether to buy at 9,000 or 8,700, because the NAVs are continuously moving up and outperformance is there. So in some schemes, the outperformance as high as 15% per annum. So even if you get the bottom, you may not get the bottom of the NAV. So what is important, because at the end of it, you are going to buy in the schemes the NAV of the scheme, and if with the bottom of the market, if the NAV of the scheme is higher, you don't get benefit even if you timed it right. So I have seen it is futile to time the market precisely, and people spend, and this is the biggest profession people have in timing the market. So but they spend too precious and too much of time timing the market, and eventually they end up buying at wrong price.
Raamdeo, with you, we get to learn about the basics of investing, and you've always said that, look, you've always looked at financial books, financial literature to sort of arrive at your investment philosophy. So just for the benefit of our viewers, which is that new book which has caught your attention and currently you are enjoying reading it?
Yeah, so I am reading a very small book called Forever Investing. I am almost at the fag end of it. Very interesting book. It is very close to the way we do things, but there is always in the books you will find some of the ideas which are better. The very concept, Forever Investing. He is saying that all the serious money in the world of the stock market has been made by the guys who broadly followed Forever Investing. The Fortune 500 guys, none of them are not forever investing, including Buffett. So Buffett talked about forever. If the company and management both are good, in that case the typical holding period is forever. That's from where the forever investing started. But if you look at Bill Gates or Mark Zuckerberg or Jeff Bezos or anybody who is rich in the Fortune 500, they're all forever investors in their own enterprises. So he's taking the cue from there, and he's saying that this everyday flipping or buying too many stocks and too frequently trading is not the way to make serious money.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.